corrections. They are healthy. They're necessary. In fact, I get more nervous when the market just keeps going up and does not go down. But big tech has been kind of a warning sign right now. What do you make of it?
Well, it's a warning sign that froth and excessive valuations are never good for investors. But in terms of this pullback showing that the markets might actually work, and any further drop from here could allow investors to nibble in and start to rebuild the position or increase the position, could be an opportunity. This work from home, shop from home craze is not going to end. It's a permanent fixture in society, and there's going to be huge dislocations. And it's important for investors to think 2, 3, 4 years out and figure out where's the cash flow going, where's the profit going, and technology stocks, communication services, the consumer discretionary sector that's run up doesn't show to me to be a bad place to be. I think that that's where the money's going, and in the future, that's where consumer demand is, and I think that's where investors should put their stock investment money as well.
Do you hedge it at all, Mark? Because the whole work from home thing, I think, is going to die as soon as it can. I can fundamentally and completely disagree. I love you, but I just think everybody's going to just do the exact opposite of what we've been doing. Is there some sort of hedge out there against any kind of a change, as people are desperate to get back to whatever miserable commute they had before? They're now actually looking forward to.
Well, I wouldn't have wanted to speak in terms of absolutes and that we all love this and we're all going to do it all the time. My point, Brian, is it's going to be a permanent fixture in society. There's going to be flex time at the office. There's going to be less occupancy. There's going to be more flexibility for workers. And that's what I mean by work from home. We're here to stay in terms of the home being an acceptable place for people to work, that people got used to some benefits of home delivery, et cetera. Likewise for investments. I'm not saying everybody should pile into tech and Amazon and other consumer discretionary stocks. What I'm saying is they should be a part of a broader portfolio that includes industrials, that includes transports, that includes select financials outside of commercial banks. And people should use technology weakness now as a way to build an overall portfolio. So I'm glad you raised the point that you did, but that's the context with which we want investors to invest in technology when there's a price opportunity like we've seen.
Valuations have obviously come down just a bit, Mark, with prices, but do you worry still about 26 times forward earnings on the S&P 500, mid-30s or mid-40s from any big cap technology names?
Yeah, we do worry about valuations, and that's why we've seen this pullback. But that's what the pricing mechanism now is doing. I think when we look at the next growth cycle with 5G, we look at who is buying Apple phones worldwide, the installed user base, the fact that every young demographic that we look at are buying Apple phones and then are going to be attached to that ecosystem, notwithstanding the risks we're reading about with how the App Store is going to be priced. We're looking at forward multiples that are justified because of the demand from consumers in that company. And Apple is driving the market. There are a few big names. I know you talk about the concentrations, but there are reasons why some of these companies are justifying the multiple. The young kids today are buying Apples, and then their world revolves on it, their music, their purchases. And we think that to ignore this massive mega trend is a mistake for investors.
Is there any value outside of equities, gold, bonds, cash, anything else? Like what percentage of cash should we be holding, Mark?
Well, cash should be very low except for what liquidity you need. Bonds have not had a bad year. I mean, this drop in rates has really helped bonds. The recovery on the credit side has helped credit. And I think people should be diversified. We talked about that a few minutes ago. And based on your risk tolerance, we think that bonds should be added in. And corporates, especially in the BBB plus, single A, the lower middle end of corporate credit quality, presents opportunities for investors to not only earn yield, but to avoid what could be some real credit issues, some significantly damaging credit risk to a portfolio if you only go into high yield. So the real warning sign for investors is avoid the biggest, fattest, juicy yields that you see right now in the high yield market. You're being paid those because there's risk. but find a sweet spot and invest in quality corporates that are still paying significantly more than cash. That's where we would tell people to put their non-equity investments right now.